Imagine your debit card getting declined at the gas station. Again, there's a line of impatient people behind you. Your cheeks burn as you fumble with your phone, trying to figure out if that transfer went through. That quiet humiliation, that's not just bad luck. It's the system working exactly as designed for millions of people every single day. Banks don't treat every customer the same. Far from it. The way they handle your account, the fees you pay, the rates you get, the service you receive, all of it shifts dramatically depending on one thing: how much money you bring to the table. Today, we're walking through the 8 distinct levels of banking, from the most painful starting point all the way to the rarefied world of the ultra-wealthy. This isn't theory. It's the quiet reality of how financial institutions sort people and adjust their behavior accordingly. Understanding these levels can help you see where you stand right now and what it actually takes to move up. Picture this. Your checking account dips negative. Maybe it's just $4 short. Maybe it's $400. The exact amount barely matters because the bank's response doesn't scale with how bad things are. The overdraft fee triggers almost instantly. Most places still hit you with around $35 per incident. Some charge per transaction, so a few small purchases while you're in the red can quickly add up to $100 or more in penalties on top of what you already owe. The cruel math here is almost poetic in its precision. If you had enough money, you wouldn't be overdrawn in the first place. But because you don't, the bank makes sure you have even less. You swipe your card at the pump. Declined. You try again. Still declined. People are staring. Your mind races through yesterday's transfers, wondering if payroll hit on time. This is what real financial stress feels like. Not some dramatic movie scene, just an everyday moment that makes your stomach drop. Banks offer overdraft protection as a so-called safety net. In reality, it means they'll cover the transaction instead of letting it bounce, and then charge you that same $35 fee for sparing you the embarrassment. Some institutions have lowered or even dropped these fees due to pressure from regulators and consumers. Many haven't. The accounts that generate the bulk of these fees belong to people who can least afford them. In recent years, banks and credit unions across the country have still pulled in billions of dollars annually from overdraft and non-sufficient funds charges, with a huge chunk coming from the same group of chronically strained accounts. You won't qualify for a regular credit card here. Loans are out of reach. There's no flexibility, no understanding, no helpful phone call. What you get instead is pure automation. A cold system that sees only one fact: your balance is negative. It doesn't know your paycheck was 2 days late. It doesn't care that the small charge was an old gym membership you meant to cancel. At this level, you're not really a customer. You're a cost center the bank is efficiently trying to recover from. You've clawed your way out of the negative. Now your account hovers between a couple hundred and maybe $600 before the next big bill hits and threatens to pull you back under. You're no longer overdrawn, but you're still in the bank's low priority zone. Then comes the monthly maintenance fee, $12 or $15 quietly withdrawn because your average daily balance didn't hit the required minimum. That minimum might be $1,500 at some places or lower at others. If you had that cushion sitting idle, the fee would vanish. Because you don't, you pay to keep the account open. You're essentially paying rent on the very account that's supposed to safeguard your money. Basic checking or savings offers almost no interest, often just a tiny fraction of a percent, like 0.01% annually. Meanwhile, the bank turns around and lends your deposits out at 7 to 24% or more, depending on the product. That's the fundamental spread that powers banking. At this tier, though, your balances simply aren't big enough for them to fight hard for your business. Trying to get a credit card? You might only qualify for a secured card, where you hand over your own cash as collateral for the credit limit you're borrowing against. In effect, you're lending the bank money so they can lend it back to you and charge interest for the favor. It's a legal, common way to start building credit from scratch. But it highlights how the system works when you're at the bottom. Service here isn't hostile. It's indifferent. Tellers are courteous enough. The app functions. Call customer service and you'll wait on hold. Before speaking to someone reading from a script who can handle routine issues. but escalates anything unusual. There's no real relationship, just a basic transaction. You need basic services. They provide them at minimal effort. You're a small number in their system, and small numbers get automated treatment. Things shift when your income stabilizes. Maybe you land a solid job or get a meaningful raise. Direct deposits of around $3,000 or more start landing reliably every couple of weeks. The bank's algorithms notice the change in pattern, from erratic and thin to steady and decent. Suddenly, real credit card offers appear in your mailbox and pop up in the app. Start today. Even small, consistent actions compound into level changes over time. You've got this. Most people believe banks reward effort, but banks don't see effort. They see patterns. You can work hard every single day and still be treated like a high-risk customer. Because from the system's perspective, inconsistent cash flow is instability, and instability always gets priced in. Here's where things quietly change. The moment your income becomes predictable, the system starts trusting you more. Not because it knows you, but because it understands your pattern. Regular deposits signal control, and control lowers perceived risk. Now think about this carefully. Two people earning the same income can live completely different financial realities. One pays fees constantly, the other avoids them almost entirely. The difference isn't income, it's structure and timing. Banks love predictability. It makes their entire model easier. When they can forecast your behavior, they can safely extend more credit. They can offer better terms, and they can reduce friction. That's when the experience improves. But here's the hidden advantage. Once you enter a better tier, the system starts working with you. Lower fees, faster approvals, better offers, more flexibility. These small wins stack quietly, and over time they accelerate everything. Most people wait for a big break, a raise, a bonus, a lucky opportunity. But the system doesn't respond to spikes. It responds to consistency over time. One big deposit won't change much, but steady behavior over months will. That's how levels actually shift. There's also something else happening quietly. The longer you stay stable, the more data the bank collects on you. And more data reduces uncertainty. Less uncertainty means less risk, and less risk unlocks better treatment. It's a slow but powerful shift. This is why time matters so much. Not just money, but time. Because trust in the system is built through repeated signals. Every on-time payment counts. Every stable deposit counts. Every avoided mistake counts. Now here's the part most people ignore. Small leaks destroy progress. Tiny fees, small interest charges, little penalties that feel insignificant. Individually, they don't seem like much, but together they slow you down massively. That's how people stay stuck. On the other side, small advantages build momentum. A slightly lower interest rate, a fee that gets waived, a higher credit limit. Each one gives you a little edge, and those edges compound over time.